because we've got those FOMC minutes just coming in. Brian, what's the headline coming out of that?
Well, the FOMC minutes again from that July 29th meeting just 3 weeks ago, where the Federal Reserve kept interest rates in the same target range at the zero bound. But the big takeaway here that the FOMC, the committee, saying that uncertainty surrounding the economic outlook, quote, remained very elevated. They said that leisure, travel, hospitality, those big consumer segments would likely be, quote, subdued for some time, and said that the job gains, which were quite positive in the months of May and June, quote, likely slowed. Now, participants did know, however, that there were some silver linings in the economic data leading up to that meeting, notably that consumer spending from the trough in April had been particularly strong, was the language that they used. Now, a lot of market participants were specifically dialed into any sort of commentary from that meeting over forward guidance, any sort of clues that the central bank could be providing in the future as to when it might lift off the zero bound, which, as many Fed policymakers have clearly said, won't be anytime soon. But still, it seemed like there was some deliberation within the FOMC about whether or not to use something like an outcome-based forward guidance. For translation, it's basically when the Federal Reserve would be using something like an inflation target or a specific target on the unemployment rate before they then commit to raising rates, or something like what they call calendar-based guidance, where the Federal Reserve says we commit to leaving rates at near zero until this point in time. Now, what they did kind of agree on, despite the fact that they were still deliberating on that, was that they would really want to codify what they called a statement on longer run goals and monetary policy strategy first. This is a review that the Federal Reserve had been doing before the COVID-19 crisis. A lot of Fed officials saying maybe we should try to clarify exactly how we're targeting inflation, for example, before we then try to pin any sort of future movement on what we're going to look at if we do target inflation as part of outcome-based forward guidance. And then the one last thing that's worth mentioning as an extension of that is yield curve control. This is something that Federal Reserve officials had been rumored to be looking at since the beginning of this crisis. This is a policy that would involve the Federal Reserve purchasing treasuries across the curve until yields on those treasuries fall below a stated target. It seemed like for some time there could be some interest in that, but with yields already so low, as we were just discussing with Brian, maybe that's a little bit weaker. That's what we saw from the FOMC minutes, the language from that July 29 meeting, noting that policy members said that this would, quote, likely provide only modest benefits, a policy being like yield curve control, which means it's likely off the table for now. But again, the big headline from that FOMC minutes just released about 7 minutes ago is that the economic outlook remained very elevated. We are not out of the woods yet. Akiko?
Brian, having said that, I mean, there's big question marks around the pace and duration of the asset purchases, and you point to the fact that not a whole lot likely to change. Having said, the expectation in the last July meeting was that Congress would act. Right now, we're at a standstill, no additional stimulus bill intact. I mean, going into the next meeting, how's the Fed likely to change depending on the outcome in Washington?
Well, this is exactly the problem. It's that it's this game of chicken for these policymakers, that being on the monetary policy side of things on Constitution Ave at the Federal Reserve, and then over on Capitol Hill with the White House and Congress continuing to work through that phase 4 package. Now, as we headed into that July 29th meeting, we knew that there was going to be that cliff that we were going to fall off when you think about things like unemployment insurance, with millions of Americans now not having access to that critical extra $600 a week in support, with many of them still out of jobs. But the Federal Reserve may have been expecting during that time that Congress would have passed some sort of extension, that they could wait to see what that package looks like before they then tweaked the monetary policy side of things. Now, as we know, there was no package that was ultimately passed. The Federal Reserve is still kind of in the dark about what's that going to look like and what type of windfall that could have for the U.S. economy if it were to be passed. Now, the minutes won't detail specifically how Federal Reserve policymakers talked about those things. We won't likely know to what degree they even talked about it until we see the actual transcripts from these meetings about 5 years from now. So for right now, all we can do is speculate. But what we do know is that from public remarks from, say, Fed Chairman Jerome Powell, he's been emphasizing that this is an epidemiological problem first. You have to control the virus before you can start worrying about what the economic recovery will look like.
Okay, Brian Cheung, thanks so much for bringing that to us. And Brian Jacobsen, I want to go back to you now. The headline, Brian Cheung, they're bringing to us that uncertainty remains elevated, job gains likely slowed as well. You look at these headlines, I mean, does that change your view in terms of the trajectory of the economy? Because it sounds like you feel pretty optimistic about where things are headed.
The headlines don't really change anything, and reading through the reports and that I was looking at doesn't really change our outlook at all. I think it's important to remember that the Federal Reserve, at that time, as Brian had pointed out at the July 29th meeting, they were making a lot of assumptions about what could happen, and they continue to, right? I mean, companies are doing that too. They're not able to give really good forward guidance, and the Federal Reserve can't really give good forward guidance, and so they're trying to figure out a way, how can they make that better? Their statements about what they intend on doing, when they might do it, instead of date-based, saying that, hey, by the end of the year, we expect that we're going to be able to do whatever, right? And maybe stop asset purchases or something like that. And instead of fixing on a date, they really want to talk about the data. And then it's a question of, is it forward-looking, so based on their projections or expectations from their models, or do they want to be more reactive to the data itself? And on my team, the way that we look at it is, next week is going to be really interesting with the economic symposium sponsored by the Kansas City Fed. That's on Thursday and Friday, where the theme is around what should they do for the decade ahead. They'll talk about the monetary policy framework. How is it that they can strengthen some of that forward guidance? They tried something back in December 2012 with the Evans rule, where they gave data points saying that let's wait until inflation runs a little bit hotter and the unemployment rate falls even more. They can give very specific targets. And then that can, I think, help investors and executives really kind of figure out when the Fed might actually act and what they might react to.
Brian, I want to get back to something we were talking about before those minutes came down, which is the U.S.-China tensions. And you alluded to some of the rhetoric that has been ramped up from White House officials. Now, we heard the president yesterday say that he was the one that actually called off the talks that was set to take place last weekend. Since then, we've heard the White House now come out and say, look, there are constant discussions in place, sort of trying to quiet any of the concerns that suggest that this trade deal could be a bit rocky right now. I mean, how do you view the back and forth that has played out here? Is this really all just rhetoric leading into the November elections, or should investors maybe consider the elevated risk right now, the heightened risk coming from the back and forth between these two countries?
Yeah, the rhetoric has been, I think, pretty predictable, as far as, especially in an election year, about playing hardball with the other side, and how much of this is just posturing versus how much of it is actually kind of substantive. I don't know of really any investor who has their hearts set on a phase 2 trade deal. Right? We had phase 1. We want to see if there's compliance with that. And that's really what the talks were supposed to be about kind of getting that check-in as to how is the compliance going with the phase 1 deal. And that doesn't really have to happen at a very high level. That can happen at a very, much more ministerial level. So I'm not sure if it necessarily throws anything into question about the status of the current deal, but it does, it kind of make it conditional, where now we know that after the election, if we do get, President Trump winning another term, he's probably not going to be all that keen on getting a phase 2 deal. There's not a huge incentive for him to do that. And so then it's a question of, well, then if you have, let's say, a President Biden instead, is he going to want a phase 2 deal? And based upon the platforms of both individuals, it doesn't really seem like that's really all that likely. So I don't think investors have very high hopes for any thawing of the tensions anytime soon, regardless of who wins.